You've got some interesting thoughts about GameStop.
Yeah.
And so GameStop, obviously, I don't know the whole history on this. So maybe you could just give us a little background on what's happened with GameStop. Obviously, it was a very shorted stock. Retail investors started to buy it to create a short squeeze, and then there were some limitations placed on the buying, I believe. But could you just like walk us through the timeline of GameStop since all this craziness started?
Sure. So, the story really starts in, I'd say 2019, 2020, where this internet personality, right? DFV, deep fucking value, also goes by Roaring Kitty, starts investing in GameStop. And he sees this as like the ultimate, basically value play, because at the time GameStop was facing some financial issues. They had large bonds that were rolling over in 2019 and 2021 that they would have difficulty paying. And he was saying, if we have a large investor come in like Ryan Cohen, who can buy up shares and invest in the company, inject capital, and turn the business around, this thing is being priced for bankruptcy when, it could be worth billions and billions of dollars. And at the time it was worth like 400 million. So he saw it as like a huge value play. So he started posting in 2020 about his position on some of the subreddits. And some of his posts started to go viral, started to grow a little bit, and really nothing came of it until August of 2020, when Ryan Cohen, who's the billionaire founder of Chewy, which is an Amazon competitor for pet food, he had 3 years previously had sold his stake in Chewy for several $1 billion, and he now came into GameStop and bought 12% of the float and got himself a board seat, and then acted as executive chairman and started making shifts in the company. And as he started buying these shares, the price started to rise, and more and more retail investors started to understand that this guy's thesis, DFV, was actually legitimate. Like, there's this large short position that's over 100% in the stock, and now the stock has like the company has an actual investor who is well capitalized and well experienced to turn this thing around. And so for the fall of 2020. We see the price start to rise. We see this company start to make some positive changes. They kick out the CEO. They shuffle the board around. He starts to, basically create a new business plan for GameStop. And then in January of 2021, the stock starts to rise, and Roaring Kitty starts to go viral on online online message boards like Reddit. And what this does is this ignites like a massive fervor for the stock, and the volatility starts to increase. And there's especially a large increase in options buying. Because if you think about it, this is 2021, like COVID's still happening.
Right.
Everyone's locked in their house, but everyone has stimulus checks. There's commission-free trading by these large brokers.
So everyone's gambling with their stimmy checks in the market.
Exactly.
Yeah.
People have nothing else to do. So people start throwing in some money on options and shares, and the stock price starts to rise. And soon people start to realize that with the short percentage being so high, I mean, it was in excess of 140%, that the shorts are really trapped, and we can really make them hurt if we keep buying shares and keep buying options. And so the price starts to steamroll higher. A research firm called Citron who publishes short research on GameStop, gets shut down. Basically, the founder just says he doesn't want to cover GameStop anymore because he shorted GameStop at 5 and it's already at 20. And so he's deeply underwater, and the price starts to go exponential very, very quickly. And that week, it's the last week of January 2021. So on the 25th, market open, the price rips from like $30 up to $80, then down to $40. And then the next morning, it rips up to like $120, $150, and then it falls down to $90. Wow. And that evening, Elon Musk tweets GameStonk, and this just massively blows this thing. It was already going viral, and it just massively blows this thing out of the water. And January 27th, the price just rips up into the 200s, into the 300s. By the end of trading, it's extremely high, and there's this deluge of news stories on the financial media that are just covering GameStop. At the time, I was working at a financial services company, and I was trying to like pay attention to the price and like what was happening while I was also working, and I wasn't doing a good job of it. So I got in trouble that week, I remember, from my boss for not doing everything, but it was truly captivating because we saw the financial media in real time tell everyone like, hey, this thing is it's a scam, it's overinflated, all these people buying are going to lose their money, they're going to lose their shirt, you're just going to hurt yourself, the shorts have closed, all these news stories came out. And at the same time, there was clearly evidence that we were doing damage. Melvin Capital, one of the hedge funds that had shorted GameStop, was down like 70% on their entire portfolio, and they had to take a bailout, the tune of $2 billion from GamePlot or from Point 72, which is Steve Cohen's firm, and Citadel. So they had to take Gabe Plotkin was the hedge fund manager of that fund, and so they had to take this bailout and be rescued from this massive short position. And several other hedge funds were also going under because they had shorted a ton of shares at 10, and this thing is now at 200.
Right. Right.
So who knows how deep their position was?
Yeah.
And then that's when things start to get crazy. Like things go absolutely insane. The next morning, the price goes parabolic and the buy button is shut off.
Crazy.
Yeah.
And how? So that sounds like rigging the game, if I've ever heard of rigging the game. They literally stop people from buying it.
Absolutely. It's like, I couldn't believe when that happened. I was in such shock. I literally couldn't even, I had to go like walk outside for like 10 minutes because I was like, what the actual like hell?
Yeah.
Like what
It's
is
not
going
capitalism.
on? Yeah. Like we had them buy the shorts. Like literally, their shorts were they were in too deep. We had our hand around their neck. They were shorted more shares than exist. They shorted well over in excess of 100% of the float. Some measures show 226% short interest, like insane short interest.
Wow.
Because again, this thing was going to go bankrupt before Ryan Cohen stepped in to inject capital.
Yeah.
And the price skyrocketing started putting all these brokers into default positions with the NSCC. And so the NSCC is the National Securities Clearing Corporation. It's the central clearinghouse for all stock market trades. And it's the subsidiary of the DTCC, which is the Depository Trust.
Yeah, which owns everything.
Which owns all the stocks in the stock market. And they're the ones who also process all the trades. And so them and the NSCC are the ones who handle all the stock market trades and settlement for the entire equity market. And NSCC, they have a value at risk model that like basically shows how much margin a broker should have on hand to deal with stock trades that are outstanding. So like I said, because there's T+3 settlement, a broker might, like, let's say a broker goes out and like quote unquote sells like $100 billion worth of stock, but maybe they don't have the shares. So they have to go borrow the shares. But in the meantime, the NSCC says, hey, okay, we'll say that these positions are clearing, but we need to have margin on just in case you're not able to get us the money or the shares to settle this trade. And so they have margin requirements, which is called excess capital premium requirements. And in that run up, there was about $73 billion of excess capital premium charges assessed for the clearing brokers. So we're talking Instinet, we're talking charges applied to Robinhood. We're talking charges applied to Apex Clearing, which is another clearing broker. Yeah. We're talking like, several other large players.
So charges applied, they had to put up more collateral.
Yes. Okay. So they were forced, they were going to be forced to put up an aggregate of $73 billion of collateral. Yeah. And the NSCC waived $55 billion worth of it during that week, during that time period, during the January run. Yeah. But what froze the stock buying on that morning was basically an order from NSCC itself to that it couldn't no longer process trades, and an understanding among the brokers that this thing was going to break the financial system. So these brokers. And when
you say break the financial system, can you expand upon that? Doesn't that just mean counterparties going bankrupt?
Yes, exactly.
Isn't that what's supposed to happen? When
it is
you
what's
take
supposed
risks
to happen.
that don't work out and they blow up? Aren't you supposed to blow up?
Absolutely. That's what's supposed to happen. That's how the financial system, that's how free market capitalism is supposed to work.
Yeah.
But as you know, we don't live in this free market system.
Yeah.
And so as the price is skyrocketing, all these brokers are being forced to put up more and more margin requirements. And finally the clearinghouses just say, look, this thing, we're looking at our positions on across the board. every single broker is going underwater. You know, they have either they themselves have put on short positions or their clients have put on short positions, and they're on hook for what their clients' positions are. And so we just have to shut this thing off because this thing is going to go exponential. And like I said, that week, options were added all the way up to like $550, and the price was at $380 in pre-market and ripping to $400, $450. And we literally started breaking the settlement system of shares because we started seeing, and again, there was like post after post of this. I still have the documents. We started seeing fractional share sales in excess of $1,000 that morning of January 28th.
Wow.
When they shut off the buy button. Yeah.
That's a future?
A fractional.
Okay, fractional.
So Robin
if you take it as a whole share, it was over $1,000.
No. So, like even the fraction of the share
was
sold
over
for
$1,000.
One fractional share was sold in the 30 seconds before the buy button was shut off.
Yeah.
One fractional share was sold for $5,266.
And what fraction of a share was it?
It was like a tenth.
So the
whole share was worth $5,000. So he sold a tenth for $526.
So the implied value was
$5,000 a share. And the price.
So that was the short squeeze, basically. Happening.
That's what was happening.
Right.
And all these banks and brokers and hedge funds were caught on the short side because they were pushing this. They were shorting it into oblivion.
Right.
Shorting more shares than exist, which theoretically shouldn't be possible.
Sure.
But it is possible because of naked shorting, FTDs, and just rehypothecation of shares.
So what does that mean? That means you have to borrow a share and sell it to short it, right? But they had borrowed more shares than exist and sold them because they weren't actually borrowing the share. When you said naked short, the other terms I'm not sure, but how do you short more than 100% of a stock that only 100% exists of?
So the way you do it is you sell a share and then you fail to deliver the share.
So you sell it to two people basically.
Yeah. You tell people that you have sold them a share, but in
That's
reality you haven't told them. Yeah, misrepresentation. And the FTD problem is something that's also not really well discussed in traditional financial media. Every single stock in the world has FTDs, but certain stocks, especially ones that are right before bankruptcy or being heavily shorted, have an excess amount of FTDs. And this has been documented for decades. There's one case I covered, I remember in 2005, an investor named Robert Simpson bought shares in a Nevada-based real estate company called Global Links. And Global Links at the time was trading at like a few pennies a share. And he bought, with his capital, he bought all the shares that exist. Actually, he bought more than the entire float. So he bought 111% of the float of the company. So the company had issued, let's say 10 million shares. He bought 11 million shares.
Right.
And he was like, first of all, how is this possible?
Yeah.
I was able to buy more shares than exist. But he moves them all to his brokerage account. And he's like, okay, I did an ACATS transfer to my brokerage.
Yeah.
They're all in a cash account, which means they can't be lent out. So tomorrow the stock shouldn't trade. Like it should just cease trading.
Right.
And in the next 2 days, 50 million shares trade.
50
million. 50 million in the next 2 days. And he went in front of Congress and basically laid this out. This was part of the SEC. This is part of the reason why the SEC did Reg Show, which is their laws, quote unquote laws against, abusive naked short selling, and which they conveniently don't enforce very well. And this was like a huge controversy at the time. There was, congressional hearings about it, and there was quote unquote some action made, but it didn't really make an effect. And that problem of hedge funds and market makers naked shorting a stock right before it goes bankrupt never got solved. Because if you think about the settlement system, like when you short a share, you sell it into the market and then you're expecting to buy it back at a lower price, right? When it falls in value. If it falls to zero or gets delisted, you never have to buy it back.
Right.
So you're selling shares that you just get to pocket all the money.
Right.
And so when a company is headed towards bankruptcy, or like let's just say that there's a company that has some mild financial issues. If you start shorting the stock and start reducing their equity, that starts reducing the options they have as a corporate board of actions they can take to raise capital.
They can't borrow.
And then they can't borrow, and then now they can't raise equity without lowering their stock value further. And then analysts downgrade them, less investment flow close.
Yeah.
People don't want to do business with them.
Right.
Like it's just
Customers start jumping ship because they're scared. Yeah.
exactly. And the thing starts to die. And then all these shorts can just pile on harder and harder and harder and drive it as hard as they can into the ground.
Right.
And, you know, there's
But if it
case
goes the
after
other
case.
way, that's the short squeeze, right? Where
Exactly.
they have to go buy it back in mass.
Exactly.
And that can drive the price higher. Yeah.
Exactly. And they did this. There's another case called CMKM Diamonds where they did the same thing. They shorted a diamond company basically out of existence. And the I think it was the CFO and the CEO had multiple meetings with the SEC, and they said, look, we've had more, like according to our own ledger, like our shareholders own more shares than exist.
Yeah.
This shouldn't be reasonable.
Right.
I want to know how many shares each broker has to figure out which broker is naked shorting. And the SEC agent told him, like, point blank, we can't do that because, you know, that would you know, break our the faith in our settlement system. So we're not going to give you that information because of that. So this whole thing is
it's inherently fraudulent.
yeah, it's a massive, massive fraud.